Simply stated, I love dividend investing, but sometimes life gets a little crazy. And it's at that point I like to go back to simple, easy investing and just pick up another share of SCHD, the Schwab US Dividend Equity ETF, which is an exchange traded fund. In fact, I try to pick up at least one share every Monday. SCHD is likely one of the most talked about ETFs, and with good reason. It's had a consistent track record of dividend growth, broad diversification, and a pretty attractive dividend yield. It's made up of 104 quality companies, and as far as ETFs goes, the expense ratio, it's pretty reasonable. If we look at the year-to-date performance, it's a little underwhelming, as it's just not keeping up with the S&P 500 for price return or total return. But could this represent a buying opportunity for those considering starting a position or maybe even adding to an existing one? What do you all think? If we dig in further and look at SCHD and what that 0.06% expense ratio affords you, we find that SCHD is based on the Dow Jones US Dividend 100 Index, which is designed to measure the performance of high dividend yielding stocks that are issued by US companies with a record of consistently paying dividends that are selected for fundamental strength relative to their peers and based on financial ratios. Honestly, as a dividend investor, isn't that what we're screening all of our individual stocks for as well? And SCHD does it for you, because each year on the third Friday of March, this ETF goes through reconstitution to make sure that it continues to meet those performance metrics. This past year, just about 25% of the companies were turned over. And if you'd like to learn more about what that looks like, I'll link a video I did explaining the process in the comments below. But before you do that, I want to share the 6 reasons why I continue to buy shares every week, and then you can decide if SCHD checks all the boxes for your investment strategy. Let's start with consistent dividend payments and look at the dividend history. The first dividend was paid out in December of 2011 in the amount of 12 cents per share, and they've been growing their dividend ever since, consistently for the last 11 years, with the most recent dividend payment of 66 cents per share, which is the second reason I like to invest in SCHD, which is the dividend growth rate. And you can see year over year, they've continued to grow this dividend. And in the last 5 years, the dividend growth rate is right at 13.92%. SCHD also offers a broad diversification with exposure to a wide variety of dividend-paying companies across multiple sectors, which means you can purchase one ETF and have strong diversification without having to invest in anything else. If we look at the diversification of SCHD, you can see that 18.42% of their holdings fall in the industrial sector. So you'd be getting companies like Lockheed Martin, Illinois Toolworks, and Snap-on. 15.28% fall in the healthcare sector. So you'd be privy to companies like Merck and Amgen and Pfizer. With 15.18% in the financial sector, you'd be getting companies like BlackRock, T. Rowe Price, and Allstate. And with consumer defensive making up 13.13%, you'd see companies like Home Depot and Genuine Parts Company. Moving from there, we've got 12.4% in technology, 9.77% in consumer cyclical, almost 9% in the energy sector, 4.5% in communication, 2.05% in basic materials, and 0.3% in utilities. The fourth reason why I continue to buy shares of SCHD is its focus on quality companies. Looking here at the top 10 holdings, which incidentally make up 40% of this entire ETF, we see Broadcom, UPS, Texas Instruments, Home Depot, Pepsi, Cisco, Coca-Cola, Amgen, AbbVie, and Merck. And if you'd like to learn a little bit more about the top 10 companies that fuel SCHD, you can take a look at this video, which I'll also link in the comments below. Now let's take a look at expense ratios. Because if we invest our money in ETFs, there is a cost associated with the management of the fund. Because SCHD is more passively managed, as it follows the Dow Jones US Dividend 100 Index, it has a relatively lower expense ratio of 0.06%. Now let's compare the expense ratio of SCHD to another popular dividend ETF, JEPI, which has an expense ratio of 0.35%. If we assume an initial investment of $10,000, annual contributions of $6,500 over 30 years, and assume a 6% rate of return, we will find that the gross value of both investments is identical at $602,145. SCHD, with its expense ratio of 0.06%, will cost you $6,990.88 over the course of 30 years, whereas JEPI has an expense ratio of 0.35%. It's going to cost you $39,531.28, which is 5.5 times the expense of SCHD. Over the course of time, this could have a significant impact on the overall net value of your portfolio. So definitely be mindful of those expense ratios when choosing your investments. Now, as a rule, I try not to chase yield, but I can't say that I'm unhappy to receive a 3.55% dividend yield right now from SCHD. It currently makes up just under 30% of my total portfolio, and my personal goal is to get that number to 50%. Last month, I received my biggest dividend payment yet from SCHD of $155, and that dividend bought me 2 more shares. And with share prices down year to date by just over 2%, I feel like I might be getting them on sale. Now, because purchasing an ETF is a more passive approach to investing, it can be a set it and forget it type of investment for you, which brings me back to where I started, finding a simple solution for easy investing. But if you vacillate between needing simple but loving complex in your search for big safe dividends, you might want to check out my latest experiment in the quest for big safe dividends by taking a peek at this video next. So this means you're investing in tools like Lockheed Martin, Illinois. Holy